Get ready to buckle up, because the gas prices are going to take you for a ride this driving season. The supply and demand crisis has taken a grip on the market, and it looks like it's not letting go anytime soon. The national inventory is falling short of expert estimates, and as a result, paying nearly $7 per gallon of gasoline will become a reality for millions of Americans. Executives in the industry are pointing to several factors, including higher pressure on crude oil markets, refinery disruptions, and increased volatility, as the drivers of the coming price spike that could double or triple the cost of a gallon of gasoline in many states in the coming months. So, it's time to say goodbye to the few months of lower gas prices we enjoyed after the historic rise that drove the national average to above $5 in 2022. In an interview with Insider, GasBuddy's head of petroleum analysis, Patrick DeHaan, warned U.S. drivers to brace themselves for a spike in gas prices due to refinery shutdowns and renewed energy demands from China, as the Asian nation reopens its economy. 2023 is not going to be a cakewalk for motorists. It is going to be expensive, DeHaan noted in the film's March 2023 Fuel Outlook report. GasBuddy predicts the national average price of gas at the pump to top around $4 a gallon in most major U.S. cities in just a few weeks from now. Get ready to brace yourselves, because this summer's driving season might hit your wallet harder than ever before. With gas prices on the rise, many U.S. cities could be seeing prices reach nearly $7 a gallon. That's right, you heard it correctly. As demand for fuel shoots up during the midsummer break, drivers may be in for a shock as they fill up their tanks. Cities on the West Coast, like San Francisco and Los Angeles, are already experiencing prices that are nearly 3 times higher than the current national average. This means that they could be in for an even bigger hit when demand peaks. With so many curveballs coming at us from every direction, it's difficult to keep up with all the changes. This year has seen an unprecedented amount of volatility in fuel prices, and experts predict that this trend will continue throughout 2023. According to industry executives, gas prices have already started to rebound and will only continue to rise as refineries shut down for maintenance following a rough winter. This will lead to a decrease in gasoline and diesel production, which will likely further increase fuel prices. To put things into perspective, last year at this time, refineries were operating at full capacity. However, recent data from the U.S. Energy Information Administration shows that for the week ending March 3rd, refineries were only operating at 85.2% capacity due to maintenance schedules at key pipelines. Meanwhile, demand for fuel has remained strong, which has caused an imbalance between supply and demand. According to industry experts, if the demand for gas continues to grow, drivers will likely see pump prices increase. The average gallon price is set to rise by at least 62 cents by Memorial Day, due to the annual transition to more expensive gasoline blends. These higher costs are going to be passed along to motorists, causing them to dig deeper into their pockets. To make matters worse, shortages in some areas of the country can drive up gas prices locally due to refinery or pipeline shutdowns, blending issues, or even gouging. It's important to note that big nationwide swings in the price of gasoline are almost always due to the price of crude oil, which is also on the rise. For the 4th week in a row, the nation's average gas price has climbed, rising 15.3 cents from just a week ago to $3.44 per gallon yesterday, according to GasBuddy data compiled from more than 11 million individual price reports, covering over 150,000 gas stations across the country. The national average is up 30.2 cents from a month ago and 7.3 cents per gallon higher than a year ago. Last week, gasoline prices continued their upward climb across most of the country, as the cost of crude oil rose and refinery issues kept the gasoline supply from increasing substantially. This was explained by DeHaan, who also noted that global factors have contributed to the increase in prices, as China's economy rebounds and production increases, leading to higher demand for refined products. Furthermore, the release of crude oil from the Strategic Petroleum Reserve has ceased, raising concerns that the supply of oil may tighten in the coming weeks, especially with the transition from lower demand to spring and summer demand. Unfortunately, motorists should not expect any relief, as prices are likely to continue to rise. China's higher consumption and a weaker US dollar are adding further upward pressure on oil prices, as the cost of crude oil accounts for more than half of the price of a gallon of gasoline. The remaining cost is attributed to refining, distribution, and taxes. Supply and demand are the driving forces behind the prices of both crude oil and gasoline, and many factors can affect them, such as economic recession, geopolitical conflicts, reduced cooperation among oil-producing nations, and tax incentives that may limit supply. However, let's not get too bogged down by the negative news. Despite the challenges faced by the industry, it's important to keep in mind the positive impact of gasoline and oil on our lives. Gasoline powers our vehicles, allowing us to travel to new places, explore new territories, and visit loved ones. Oil-based products are used in the production of everything from plastics to cosmetics to fertilizer. So, while it may be frustrating to see the price of gasoline continue to rise, we can take solace in the fact that it is enabling us to live our lives to the fullest. Diesel consumption is not just a measure of how much fuel is used, it's also an important indicator of the economy's health. Unfortunately, the current trend is not looking good. We seem to be headed towards a double recession, one caused artificially by interest rate hikes, and the other a natural result of deteriorating conditions for businesses and consumers. Irina Slav, from oilprice.com, explains that the oil industry is feeling the effects of both inflation and higher borrowing costs. This has led to slower spending and growth plans. The U.S. manufacturing sector has also been struggling with 4 consecutive months of contraction. This is not good news for the GDP. The way out of this mess is for refiners to ramp up their production of distillate fuels, but this won't happen unless there's demand for them. Unfortunately, there's also the problem of smaller refining capacity due to recent refinery conversions and closures. All of this points to continued pain ahead for the U.S. economy, as Slav has outlined. But that's not all. There's also an auto loan crisis brewing that threatens to trigger the biggest wave of car repossessions the U.S. has ever seen. More and more consumers are falling behind on their car payments, and financial analysts fear that this trend will continue into 2024. Consumers are having to stretch their budgets just to afford a vehicle. It's no secret that the cost of owning a car has gone up over the past few years. In fact, the average monthly payment for a new car has increased by a whopping 26% since 2019, reaching a staggering $718 per month. And it's not just car payments that are causing financial strain. Other costs, such as gas, insurance, and repairs, have also seen significant spikes. Unfortunately, the rise in car-related expenses has led to a surge in loan defaults, leaving lenders scrambling to keep up with demand. Jeremy Cross, the president of International Recovery Systems in Pennsylvania, has seen firsthand just how difficult it can be to repossess cars in a timely manner. With so many borrowers defaulting on their loans, the repo market simply can't keep up. In fact, the situation has gotten so bad that many repossession companies have had to close up shop. According to Cross, the number of repossession companies has dropped by 30% since 2020, as workers have found jobs in other industries. Now, the remaining companies are stretched thin, with lenders offering premiums to ensure their cars are repossessed first. But what does all of this mean for the average person? Well, if you're one of the many Americans struggling to keep up with car payments, it could be bad news. As loan defaults continue to rise, we can expect to see a big wave of repossessions in the coming years. Lenders are already anticipating this, with many offering financial incentives to stay ahead of the curve. The situation is getting out of hand, and it's causing concern among officials at the Consumer Financial Protection Bureau. The auto market is showing troubling signs, particularly among subprime borrowers, with below-average credit scores and those who took out loans in 2021 and 2022, when auto prices were abnormally high. These loans are performing worse than in previous years, and Ryan Kelly, acting auto finance program manager for the CFPB, explains that it's because consumers had to finance cars once the supply chains were jammed and prices went up. It's a double whammy for these consumers as they were hit with inflation twice. First, they had to finance a car after prices had gone up, and then they had to pay for gas when the Russia-Ukraine conflict started. The oil market, gasoline, diesel, and auto industry conditions are deteriorating faster than anyone could have anticipated. It's becoming a nightmare scenario, and U.S. drivers should prepare for more uncertainty and pain ahead as the perfect storm begins. However, there is still hope. As prices continue to rise, it's essential to focus on ways to minimize costs and make better financial decisions. One way to do this is to consider buying a more fuel-efficient car that can save on gas costs. Another option is to explore public transportation or carpooling, which can also save money and reduce the stress of driving. Additionally, it's crucial to seek financial advice and explore different financing options that can help manage debt and payments. As we navigate through these challenging times, it's essential to remain calm and focus on making informed decisions. While the road ahead may be bumpy, there are ways to navigate the storm and come out on the other side. Let's stay positive and work together to overcome this challenge.